Welcome to the deep dive. Today, we're doing what we do best, which is really cutting through all the noise,
All the complexity.
all the jargon, and frankly, the intimidation that just surrounds finance. We're diving deep into the work of J.L. Collins and his philosophy, The Simple Path to Wealth.
And our mission today,
Mm-hmm.
it's not to find the next hot stock or some, secret trading trick.
Right.
It's to unpack the core actionable principles that allow anyone to gain true financial independence. If you follow these rules, the path is it's almost mathematically guaranteed.
And what are those rules? Collins boils the whole thing down to just one sentence, right?
Just one. Avoid debt, live on less than you earn, and invest the surplus.
That's it.
That's the formula. Everything else is just noise.
It sounds so simple, so intuitive, and yet it completely flies in the face of what our entire culture teaches us.
It does.
Collins points out this fundamental misconception we have about money.
Yeah.
We think about it only in terms of what we can buy with it.
Exactly. We see it as this, transactional tool for consumption.
Right.
Ask anyone what they'd do if they won the lottery. The answers are always about buying stuff. I would pay off my debt, buy a huge house.
I'll buy a Lamborghini.
Right. It's a shopping list,
Yep.
the list of acquisitions. They're only seeing money as a way to swap currency for goods, for stuff.
That's the trap.
That is the trap. The critical reframing here, the thing you have to understand, is that money can work for you.
Right.
We all start by trading our time and effort for money. That's the starting point.
Yeah.
But the breakthrough happens when you divert that earned money into investments.
And that's how money buys you something else.
It buys you freedom, something infinitely more valuable than a luxury car. Because as long as you rely only on that paycheck, you are, by definition, beholden to whoever signs it.
Yeah.
You don't have true freedom.
Okay, so let's unpack this step by step. If the mission is freedom, rule number one is avoid debt. Why is that the absolute first move? Why not just jump straight into investing?
Because debt, it's a financial ball and chain. It is constantly dragging you down.
It's an anchor.
It is. Collins uses this great analogy. He says it's like asking a world-class swimmer to compete with a weight strapped around their waist.
You just can't win.
You can't. You can be the hardest worker, the smartest investor. But if you're paying, say, 18% interest on credit cards, you are running backward.
Yeah.
Financially, you are just losing ground every single day.
So when you decide to finally attack that debt, what's the smartest way to do it?
Well, you hear about the snowball method, paying off the smallest debt first for a psychological win. And that's fine.
But it's not the most efficient.
Not financially. The smartest way to win is to focus ruthlessly on a debt with the absolute highest interest rate first. Pay the minimums on everything else, but every single extra dollar you have goes to that highest rate.
So if you have a credit card that's charging you 22%, paying that off is like getting a guaranteed 22% tax-free return on your money.
Precisely. Find me an investment vehicle on Earth that can promise you a guaranteed 22% return. It doesn't exist.
Wow.
That's why paying off high-interest debt is the first and honestly the best investment you can ever make.
And that whole process, that struggle to pay it off, it forces you to learn the second rule, which is maybe the hardest one.
Living below your means.
Yeah, that's a real psychological hurdle. Collins calls it the tyranny of the must-haves.
Oh, it's such a great phrase. It's this idea that you feel obligated by social pressure, by your neighborhood, whatever, to have a certain lifestyle.
Yeah.
You must have the 2 new SUVs. You must live in that expensive school district.
Right, the must-haves just eat up your entire paycheck. They expand to meet your income.
They do. And that tyranny is just deadly to building wealth. Collins tells this story about a friend of his making $1 million a year who was always broke.
$1 million a year, broke.
Broke. Because he was constantly competing with the Joneses. His lifestyle just ballooned. But then you contrast that with another friend who made under $40,000 a year and became financially independent.
Because they needed less.
They needed less. Their required lifestyle was just so much cheaper. It proves it's not about how much you make. It's about the gap between what you make and what you spend.
And there's an upside to that painful debt payoff phase, isn't there?
There's a huge upside. It forces you to build the discipline. You learn to live on less during the struggle. So when the debt is finally gone, you've already built the lifestyle you need to start piling up assets.
Okay, this is where things get really interesting and maybe a little controversial.
Yeah, this one gets people talking.
Collins argues that if your goal is early financial independence, you probably shouldn't buy a house. especially when you're young.
That claim really raises eyebrows, doesn't it? Because for generations, we've been told homeownership is the bedrock of middle-class wealth.
It's the American dream.
It is.
Yeah.
But if you look at it purely through the financial lens of early independence, it has two really big drawbacks.
Okay, what's number one?
Number one is that your capital just sits there. It's idle. The huge down payment, all the equity you build up, it's illiquid. That money is locked up in a building. It's not earning anything.
It could be in the market.
It could be in the market, compounding away. And number two is the cost structure.
The true cost.
Yes. The industry, the banks, they all push you to buy the absolute most house you can afford because they make more money that way. But that mortgage payment, that's just the starting point.
It's the tip of the iceberg.
It's just where the costs begin. Think about it. Maintenance, property taxes that go up forever, landscaping,
Yeah.
and then the big unpredictable stuff.
For $20,000 new roof.
Or the $25,000 septic system that fails. When you rent, your cost is fixed. You know what you're paying. When you own, you are on the hook for these massive variable costs that can wreck your budget.
And the data really backs this up now. I mean, since 1980, U.S. home prices are up over 300%. But wages, they've barely budged.
They haven't kept pace at all. Renting is often just flat out cheaper. And then there's the other thing, especially when you're young. Flexibility.
Right.
A mortgage anchors you. It psychologically ties you to one place.
Yeah.
What if a huge career opportunity comes up across the country? Or, you need to move from London to San Francisco.
It's a massive headache.
It's a huge headache. The costs of selling a house, commissions, taxes are enormous. Getting out of an apartment, it's clean, it's simple.
So to be clear, the point isn't that houses are inherently bad.
No, not at all. Collins has owned homes. He just views them as an expensive indulgence, something to enhance your life, not an investment to build your wealth.
You hear the success stories, the person who bought in San Francisco 30 years ago.
You always hear those. You don't hear about the person who bought in Detroit right before the decline.
Good point.
So if you can easily afford it and it makes you happy, great. Just don't confuse it for the real wealth engine.
Which is stocks.
Which is stocks. They are the single most effective, most powerful wealth-building tool ever created.
Okay, but as soon as you say stocks, people get nervous, the market is volatile, everyone is asking, is it safe to invest right now?
And the answer depends entirely on that phrase, right now. Let's separate risk by your time horizon. In the short term, let's say money you need in the next 5 years. Stocks are never safe. They're incredibly volatile. Crashes and pullbacks are normal. They happen. You can't predict them.
So money for a down payment in 18 months?
Should not be in stocks. No way. Let's keep it in cash. But if you zoom out to the long term, stocks are stunningly reliable.
Over 20 years, say.
Over 20 years, they are extremely safe. They consistently outpace inflation. The danger isn't the market dropping. The danger is you panicking and selling at the bottom. The storm always passes. You just have to be willing to sit in the boat.
So long-term stocks are the engine. What's the fuel Collins recommends?
Broad-based, low-cost stock index funds. He talks a lot about VTSAX, which is Vanguard's total stock market index fund.
And what does that mean exactly?
It means instead of trying to pick the one winning company, like the next Apple, you buy a tiny slice of every publicly traded company in the U.S. We're talking about like 3,600 businesses.
You're betting on the entire economy.
You're betting on the whole market. And here's why that's so brilliant. He calls it self-cleansing.
Self-cleansing?
Yeah. The fund is weighted by company size. So if an old dominant company like, say, Sears fades away, the index automatically owns more of the new aggressive competitor that's replacing it, whether that's an Amazon or a Walmart.
So you don't have to predict the winners.
You don't. You just own everything and you automatically benefit from whatever succeeds. It's totally passive.
What about something like Bitcoin, the high-risk, high-reward stuff?
He views that as pure speculation.
Yeah.
I mean, for all its past performance, its crazy volatility means it can't really function as a currency, which is its whole point.
Yeah.
The focus for wealth building is on durable assets, on the underlying value, not the speculative froth.
I got it.
And now we get to the part where the truly jaw-dropping power lies. Compounding. It's the phenomenon that makes the growth chart look like a hockey stick.
That visual is just, it's unbelievable the first time you really grasp it.
It is stunning. Because we're all wired to think linearly. But, okay, let's use the example from his book. You invest $500 a month, every month, for 35 years. At an average 8% return, you'll have over $1.04 million.
Okay.
But here's the mind-blowing part. Of that million, you only put in about $200,000 of your own money.
So over $800,000.
Over $840,000 came entirely from growth, from your money making more money. That compounding engine eventually becomes way more powerful than your paycheck.
It's the power of time. The money you invest in your 20s is just, it's incredibly valuable.
It's everything. And to speed that up, you can use things like 401ks and IRAs.
The tax-advantaged accounts.
Exactly. The government incentivizes you to save. You invest with pre-tax money, so your pile starts bigger, and it all grows tax-deferred. The idea is you'll be in a lower tax bracket when you finally take it out in retirement.
And for someone trying to put this all into practice, what does a simple asset allocation look like?
He keeps it incredibly simple. For himself, he says he holds about 80% in stocks. That VTSAX fund 15% in bonds for a bit of a smoother ride when stocks crash, and then 5% in cash. That's it.
So simple. Okay, let's shift from mechanics to the mindset. Collins is really clear on this. Money buys you options, but it doesn't necessarily buy you happiness.
No, it acts more like a magnifying glass for who you already are. If you're an unhappy person without money, you'll probably just be an unhappy person with fancier problems. He says some of the richest people he knows are also the least happy, haunted by that same drive that got them there.
I think most people connect with the idea that money doesn't really add happiness, but it can remove unhappiness.
That's the key psychological insight.
It removes the anxiety, the stress of living paycheck to paycheck, the lack of freedom.
It does. And that connects to the parable of the monk and the minister. The minister tells the monk, hey, if you learn to cater to the king, you won't have to live on rice and beans.
And the monk says,
The monk replies, if you could learn to live on rice and beans, you wouldn't have to cater to the king.
the beauty of needing less is being beholden to no one.
Exactly. And that emotional ability to not need to prove yourself is also a superpower in investing. There's this fascinating data from places like Vanguard.
What's that?
It shows that men consistently underperform women as investors year after year.
Wow. Why?
It often comes down to tinkering, ego. Men are documented to trade about 45% more often. They're trying to time the market, pick the perfect moment.
They're trying to be the hero.
Yes. And all that trading just leads to more fees and worse returns. Collins jokes that people who just lose the password to their investment app have a superpower because they can't make those emotional mistakes.
Just stay out of the way. That sounds like something Charlie Munger would say.
It's pure Munger. The single worst thing an investor can do is get in the way of compounding. Just let the engine run.
So, what does this all mean for you, the listener?
I think the key insight of this entire deep dive is really simple. Financial independence is the point where your investments throw off more money than you spend. And the ultimate benefit is that everything becomes, well, not free, but it's purchased from a position of choice and strength, not desperation.
And, while Collins is a financial guy, his deepest reflections aren't about money. He shares these two non-financial regrets.
Yeah.
One, rejecting a jigsaw puzzle his dad gave him as a kid. And two, when he was 24, his dying father wanted to talk about death, and he just offered empty reassurances instead of really listening.
And the point is that money buys you the time and the freedom to not make those kinds of regrets, to be present for the people who matter.
It's the freedom to make fewer non-financial mistakes.
And on that topic of life decisions, let's leave you with one final provocative thought. Because decades of financial discipline can be wiped out in an instant if you're not careful about one core relationship. It's a huge one. Collins stresses the critical importance of choosing your spouse carefully. He tells this story about a wealthy friend whose 6-year divorce was just catastrophic.
What happened?
The friend was forced to pay the other side's lawyer, a lawyer who had zero incentive to end things quickly. He was forced to liquidate 20-year-old stock holdings, triggering massive taxes, all to satisfy a judgment on assets whose value had been inflated by the lawyers.
That's a chilling story. It's a reminder that who you choose as a partner is one of the biggest financial decisions of your life.
It is. You're either operating under the government's prenup, the default laws, or you're intentional with your partner beforehand. That choice is just as critical to your financial security as anything else we've discussed. It is the ultimate non-financial risk that protects your financial freedom.
Thank you for taking this deep dive with us. We hope these simple yet profound principles help you chart your own path to wealth and, most importantly, to freedom.